let's take a step back and understand what has happened in the world. What kind of liquidity has been pumped in? It's everybody's favorite punchline that this is a liquidity-driven rally. But you need to understand how much liquidity has been pumped in. And usually when this kind of liquidity is pumped in, what happens to the market? So, unprecedented global coordinated stimulus has been provided to the world economy. Now, one might argue that this will have serious consequences down the line. Surely it will, but we will have to cross that bridge when we get there. We cannot be worried about the secondary consequences without taking into account the primary consequences of the same. If you are going to give a stimulus which is greater than 10% of the world's GDP is roughly about $85 to $90 trillion, and the global central banks, only the large ones, have printed more than $9 trillion and counting, then what is the kind of impact that will be there on the world market? You can imagine. Last year, the central banks increased their asset base by 52%. And on top of that, in 21, they are going to increase it by another 13%. The devastation caused by COVID is nowhere close to what was caused by World War II. Yet, the stimulus levels are reaching the World War II level. Besides the regular revenue and expenditure measures, the central banks have provided loans, loan guarantees, equity injection. Now, equity injection is something that was considered beyond the tools of central banks. It has now become an accepted method. Not many businesses are being allowed to fail. Even a business like cruise liner, where the revenues have dropped 95 to 99%, are also receiving a lease of line from the investors. On top of the fiscal stimulus is the monetary response. The interest rates have been cut across the board world over. And this has led to unprecedented low interest rates in human history ever. If you are going to give this kind of huge injection to the world economy, obviously there are going to be bubbles. Just to give you some sense of what has happened when the previous liquidity injections were provided and its impact on the equity market. So in 2001, famous Alan Greenspan created the first QE, or quantitative easing as it is known. Let's take a look at the proportion and its impact on the market. At that point of time, this was right after September 11, the global market cap was $23 trillion. The injection provided at that point, the money supply was increased from 6.2 to 10.3%. The fiscal deficit increased by 3.8%, and the asset purchase program was about 0.9 trillion. Now, 0.9 trillion was big. It was about roughly 3% of the global market cap at that point of time. This resulted in 6 years of bull market, and the market cap added was $63 trillion in 6 years' time. The global market cap went to $63 trillion. Now, but again, you cannot prevent the economic boom and bust cycle. So we had the global financial crisis. That point of time, again, the helicopter Ben came to the rescue of the market. Actually, they were trying to rescue the economy, but for all practical purposes, it was rescue of the market. So he increased the money supply from 6.2% to 9.4%. Fiscal deficit increased by 7.9%, and the asset purchase program was triple of what was done in 2001-2. And what happened to the world market cap after that? 11 years of sustained bull market in US, and the world world market cap went from 32 trillion to 90 trillion dollars in 11 years time. And then struck COVID, which brought the market cap down to $65 trillion in the March of this year. And now this time the James Powell and company has unleashed a tsunami which remains unparalleled in human history. And the first order impact of that has been that the global market cap has gone from $65 trillion to $103 trillion in 10 months time. Now we cannot be very sure that these liquidity injections will work the same way that it has in the past. We also do not know when we reach a stage where the Fed ends up pushing at a string and their injections don't work anymore. However, liquidity needs a home, and it will find one, and that is not going to change. It might move from asset class to asset class. It might move from geography to geography. It might move from time to time from various places. But until such event occurs, which sucks out most of the liquidity, like the global financial crisis that happened in 2008. Until that needle meets the bubble, the bubbles are going to grow larger and larger.